Well, good morning, everyone, and thank you for joining us this morning for the September 18th FOMC meeting recap. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenter today by using the chat feature. As you'll see, I just put a chat in there. So if you're looking for where that notification came from, you can find the chat at the bottom of your screen. If you are on a mobile device, there's going to be three little dots. And if you're joining us from a computer, there should be a button that says chat. Before we begin, I'd like to introduce our economist on the call today, David Widmar, co-founder and managing partner of Agriculture Economic Insights. David was kind enough to glean the information from the meeting yesterday, interpret the data for us, and share his perspective of what yesterday's findings will mean for the overall economy, as well as, more importantly, at the farm gate. And so as a reminder, this webinar is intended for informational purposes only and is not for public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. And so we had quite a few questions that got thrown into the process during registration, which we really appreciate because that helps guide the conversation. And we're going to do our best to get to those questions on the backside of David's presentation. And so with that, David, I'll turn it over to you. Thanks for being here this morning.
Well, thank you for that introduction, Micah, and thank you all for joining. I think this is a really great time to be thinking about interest rates. One, the Fed, of course, made a pretty big adjustment, lowering the target rate by 50 basis points. But I think the other really key element to this update, and probably overlooked by a lot of us, is that there's been sort of a reshifting of expectations. And so it's a great time to update our expectations, update our base level of thinking, because especially as we think about interest rates going into 2025, the Fed did shift its course a little bit. So we want to make sure we're updating those expectations. One of the things that I shared with you all last quarter when we had this update conversation is the team at AEI wrote a article sort of laying out the arguments on the interest rate situation. So there's this higher for longer argument and this lower sooner argument emerging on the interest rates. And so now we sort of know the Fed's action. Of course, we saw them take a pretty bold move in lowering those rates 50 basis points, a half a percentage point. But let's use this template to sort of, size up where we are and how we got there. So look at the higher for longer argument. We mentioned that if inflation remains stubborn, that was going to be a key element. I'm going to show you in a few graphs. Inflation has not been stubborn, so we can take that consideration sort of off the table. Continued government spending spree, little interest to address that. This issue hasn't really surfaced, so we're going to leave it on the table. And then, of course, the tight labor market, which was going to put a lot of upward pressure on wages. We see the labor market being less tight. We see unemployment rates ticking higher, more towards a neutral or a normal level. So you take two of those higher for longer arguments off the table, and so that sort of tips the scale a little bit towards the lower to sooner action. Now let's look at the key elements over here. The first one I point out is continued low productivity growth, slow economic growth, and I put a box around that. I'm going to show you here in a little bit how the Fed's expectations around GDP came down just a little bit here for the U.S. economy. And then the other one I want to point out here is, and I put this in a lighter shade of green, it's still out there, it's still being discussed. We don't, of course, have a recession declared or looking at it, but there's still concerns about this looming recession. And of course, if you have interest rates really high for too long, that risk does become more likely, and so the Fed was taking a step back here in that situation. So I think this is a really great scorecard to sort of recap, okay, why did the Fed go out and take this action that they did? And these are some of the issues that they were, of course, following and tracking. The other thing I really want to make sure we talk about is the Fed mentioned a few different places that they had more confidence than they had when they last met at the end of July. And I think this is a really key update in the decisions that the Fed was able to make. We saw more data, especially around inflation and the labor market, giving them some confidence to really take this decisive move. Now, once a quarter, when we have these webinars, the Fed, in addition to their regular meetings and decisions about where to put the benchmark rate, the Fed also provides this summary of economic projections. You'll hear the Fed chairman refer to this as the SEP. And this is basically a survey that the participants all fill out, and they're sharing their expectations around GDP, unemployment, inflation, and where the Fed funds rate might be. These aren't an official vote. It's just a way for them to compare sort of a benchmark, a level setting of where them and their fellow colleagues are. These data are anonymized when it comes out to the public, but the idea here is just to sort of get a ground truth and a feel for where things are at. I think these are really good for helping us understand the decisions the Fed make. Now, these aren't good necessarily at forecasting. They're just simply because the environment changes quite a bit. But this does a really good job of helping us understand how they went about making the decisions that they made. So we're going to talk about this first one here, the change in real GDP. So this is inflation adjusted GDP in the US economy. Back in June, the expectations were around 2.1%. They've cooled just a little bit, down to 2%. Okay, so this was, again, part of that ledger I was showing you earlier. The other piece here is that unemployment expectations were at 4% in June. Now they're at 4.4%. And so we see a little bit higher unemployment rate. Now, unemployment rates are a difficult conversation because we don't want anybody in the economy to be without a job, but then there's also sort of this healthy level of unemployment, and that's probably close to around 5%, maybe that 4.5 to 5.25%. There's a little bit of debate about what that is, but the idea here I want to point out is when unemployment's running at 4% or maybe in the high 3%, that's a really difficult labor market because it's often results in high pressure on wages. So let's think about even our rural areas of the rural economy. When you have a 4% or 4.4% unemployment rate nationally, you're going to have counties that have very, very low unemployment rates and have a hard time filling those jobs. And so it's in a way holding back the economy growth, but it's also creating that pressure on wages. And so the Fed definitely sees this as a step in the right direction. They're happy to see this unemployment rate both in 2024, 2025, and 2026. They see this ratcheting up on all three of these years looking out for. So this is a positive step. We're going to talk a little bit about the dual mandate. The Fed's starting to talk about that a little bit. They want to make sure they get full employment, and that full employment, so we talked about kind of at a normal level, and they also want to get inflation back under control, closer to that 2%. Speaking of inflation and getting closer to 2.0%, the Fed also improved or their expectations showed a improvement in the PCE inflation coming in now close to 2.3% for 2024, down from 2.6% just last quarter. And you can see also expectations improved for 2025 as well. The last piece here, the piece that you all came to watch and learn more about, is expectations around the Fed funds rate. And so the June projection among the participants was a median of 5.1%. And we talked about back in June how it was a wide range of expectations. Well, for the latest update here in September, that median fell quite a bit. That median's now at 4.4%. So this represents a target range between 4.25% and 4.5%. So what does that mean? Well, I want to point out over here in the corner, that is the two rates we've already seen, and then the median expectation is for 2 additional cuts. And so what I've done here is I've tried to summarize what the 2024 and 25 expectations were at the other quarterly meetings that we had seen them. So last quarter, the median expectation was for 1 cut this year, and then of course we saw the median expectation for 3 cuts back in March. Now, there was a wide range of expectations for each of these, but we already put 2 cuts on the books, and maybe there's room for a couple more. And I'm going to show you that dot plot here in a little bit. And then, of course, we also still see 4 cuts in for 2025 and then more cuts potential for 2026. One of the key takeaways here is not only did the Fed move in a way bigger than most might have initially anticipated, they also, kind of have a lower, sooner approach as they're putting this out. So what does that mean? We're going to get rates to a lower level at a sooner trajectory. Now, the other thing I want to point out here, I think it's really, really important, is look at where they are for 2027 and in the ambiguous long run. It's closer to 2.9%. The real key takeaway here, I think, is that the Fed is not signaling in any way, shape, or form an expectation to have short-term interest rates returning to this near zero level that we had been at prior to 2022. Between 2010 and 2022, we had this not in all cases at all times, but that was generally speaking an era of very low interest rates. We saw interest rates much closer to 0% than we did here at this 2.9% or this 3% level. So keep that in mind. We're going to see interest rates come down, but no signaling that we're going to have a return to near 0% Fed funds rates. Now here's the dot plot that I was talking about earlier. First thing I want to point out is there was one dissenting vote out of the FOMC meeting. One particular governor expressed that they thought 25% basis points was the more appropriate approach, but the vote turned out to move 50 basis points. And we were talking about this even back in June, and I sort of noted everyone uses this idea of one cut or two cuts, and we kind of say one cut equals 25 basis points, and that assumes that will be one action, and then the next two cuts would be, two actions that equal 50 basis points. And I was sort of warning back then that, they can move more than just one cut at a time or one 25 basis point movement, and that's what they have done here. And I also want to remind you that back in 2022, when they started to raise rates, they raised them by 3/4 of a percentage point, or 75 basis points right out the gate. So that was, again, another situation here where the Fed moved slower than what most participants or most observers thought they should. But when they moved, they made it in a pretty decisive way. So we have a patient but decisive Fed that's been at the helm here and holding the reins, and I think this is another reflection of that. So what does the dot plot tell us? 2 additional cuts possible in 2024. Oh, excuse me. For 2024, zooming in here, I misspoke here. 2 participants thought that there'd be no additional cuts. One of them thought there would be one additional cut, and 9 here thought that maybe this 2 additional cut. That's how we got to that median, and 3 had one had 3 additional cuts. So a little bit of a wide range of expectations here, considering there's not a whole lot of calendar left in 2024, but they still have a couple of meetings right after the election and one there in December, and so they're going to have opportunity to make some additional adjustments here in 2024, but then also look at 2025. We still see another situation where maybe a full percentage point, maybe up to 2 percentage points from where we stand today could be in the move or in the cards, so to speak. So we want to keep a really close eye on this as we start to think about how the Fed moves and trends in this direction coming forward. We could see a lot of movement in interest rates, or the majority of the movement, I should say, between now and that ambiguous long run could take place in the next 12 months or so. Now, I want to reiterate, things can and do change. This isn't a Fed forecast. They are not sort of locked into this. This is not official guidance. This is just sort of setting the baseline for expectations. And as new information comes in, is available, they will dial in and tweak this. One of the graphs I think is really important to keep an eye on is this relationship between short-term and long-term rates. We've seen this gap closing. And of course, the gap I'm talking about is in red, is 1-year Treasury notes and the interest rate on those, and then in blue is the longer term. So when the short-term rates are higher than the long-term rates, this is a yield curve inversion, and this inversion has been underway since about mid-2022, and there's a lot of things that could be explained. This is often seen as a warning sign for a looming recession, but I think it also more holistically represents a disconnect between short-run and long-run expectations. And given the inflation situation that we had been dealing with in that mid-2020 era, there's a lot of sort of narratives also around we think inflation will be short-lasting. So we need to have higher short-term rates, and we can get away with lower long-term rates because this inflation will be short in duration. So we still have this inversion. The inversion has been closing. But what I really want to point out here is that the inverted yield curve meant that long-term rates didn't move up as much as maybe they should have. So long-term rates were buffeted a bit from the higher interest rate environment. One way to think about this is if this relationship would have followed out, these long-term rates, this blue line could have been way up here. But we didn't see that. There's a little bit of buffeting here. Now on the downturn, this could mean that long-term rates are a little bit buffeted to the downward movements as well. So we might see long-term rates a little slower to adjust downward, but we need to keep an eye on this. We'll see how this plays out. Of course, long-term rates are really important for agricultural loans, thinking about machinery that are, multiple years, approaching 4 or 5 years for machinery notes, and of course, land. I want to wrap up here by talking a little bit about the inflation and unemployment data, really zoom into these. This gets back to this dual mandate that the Fed's kind of always had. There's different seasons when they talk about it more than other seasons, and this is definitely a season when they've been starting to talk about it a lot. So on the left, this is the year-over-year change. So we look at the PCE index. There's a couple different measures of inflation. PCE is one that the Fed uses very, very closely. CPI might be one you're more familiar with, but PCE has some features and benefits that the Fed really leans heavily on. So you can see this PCE inflation, we were above 7% about 2 years ago, and now we're hanging in, in the 2.5 window, 2.5%, middle of the road, getting close to this 2.0 threshold that the Fed has set for themselves. So lots of improvement and lots of changes. This is specifically measured by what's the index value today versus 1 year ago. The other way of looking at it, this is sort of maybe a noisier way of looking at it, but it's sort of a zoomed in, it's a month-over-month change in that PCE index. So it's a lot of noise. It's really hard to interpret what a 0.5% month-over-month change looks like on an annualized basis. But the idea I want to point out is there's definitely a downward trend, and some of the more confidence that the Fed has been able to zero in on throughout the summer here is that we are at a cooler inflation levels than we had at the beginning of the year. So to state this a little bit differently, the story about inflation on a year-over-year basis has looked pretty similar throughout the entire calendar year. But when you zoom in on inflation on a month-over-month basis, and this is what the FOMC participants, this is their job, is to really watch this, they're getting much more confident about the economy, and they were able to lower rates in that big way because they were really watching this month-over-month changes, and they could see, okay, we had a little bit warmer inflation at the beginning of the year, but the second half of the year has been, or excuse me, the first quarter, the second quarter, and the early part of the third quarter has cooled off a lot. And so this is one of the reasons why I think a lot of us thought, why did the Fed wait until September? Well, we didn't have as many data observations that we were definitely down here. You can see there's a roller coaster up and down, and we expect the sort of economy to still go through this. It's a bit of a two step forwards, maybe one step backwards type of an approach. And so we want to make sure this trend line is still going in the downward trajectory. The other data point here is unemployment. And you can see I took a big snapshot of this. One of the things to point out here is we had a pretty tight labor market before the pandemic. And then we've had a very tight labor market, really back in 2022 and 2023. But over the last year or so, this has started to creep a little bit higher. It's, approaching that 4% threshold, maybe 4.5% for the year. What's a normal or a neutral unemployment rate in the economy? There's a wide range of debate about this, but the idea here is, first off, unemployment never stays put for very long. It's always sort of moving up or down. But the idea here is we're starting to get to a point that's less concerning about wage inflations and the tightness of the labor market. So this is giving the Fed a little bit of ease that they can lower interest rates and take the foot off the brake a little bit on the economy. So what do we have moving forward? Of course, we have the September FOMC meetings. We're going to continue to have updates on unemployment measures and inflation measures. We have the U.S. elections on the 5th, and the FOMC is going to meet there on the 6th and 7th. So that's another opportunity for them to adjust the interest rates and maybe lower them again here in November. We'll see how that plays out. But then in December, there'll be another meeting where they're going to update their projections, those summary of economic projections, and that'll be their second and final meeting of 2024. I want to wrap it up here, just a little bit of summary. So these rate cuts that have been talked about, we really started talking about these a lot back in December. Of course, that inflation spike there at the beginning of the year put those to the back burner, but rate cuts have finally arrived. I think this can be best summarized as a patient but decisive Fed applying less braking to the economy. I talked about last quarter, the balance sheet taper remains, so we're still selling off the Fed's balance sheet. That's another form of braking on the economy, but it's still at a slower rate. The Fed's starting to talk about this dual mandate, so they're focusing on getting this labor market back towards a healthy level. Is arguably too tight. And then I think the key piece to underscore here, one of the big changes back from June and even early July, is that inflation expectations are lower. There's more confidence about inflation getting back to 2%. The unemployment is slightly higher. That's not at a concerning threshold. It's sort of going back towards maybe more of a neutral. And then, of course, the economic growth has slowed. And so these are all signs, I think, of a healthier and economy that's maybe in a better position. Now, there's a lot of ways you can look at this. There's always this concern about the looming recession. Some of these will, I think the Fed has a hard situation. Half the audience is asking them questions about, the economy overheating, and the other half the audience is asking questions about, is there should we be concerned about the labor market? Should we be concerned about slowdown in economic growth? So there's this fine line that they're treading, and I think we've finally seen a situation where they're stepping away from the braking and we're applying less braking, but of course, we're still watching all these developments very, very carefully. One of the big things that could change the Fed's plans in a big way, in a hurry, is either confirmation of of a recession, or confirmation that inflation is stubborn and rears its ugly head again. Those are the two things that could really change the Fed's trajectory on interest rates in the next 6 to 18 months. We'll keep a close eye on there. So I'm going to wrap up here, or pause here, and have Micah come back, and we'll discuss questions that you all have been submitting.
Thank you. Thank you, David. The first one that I kind of want to get to, and I think is interesting, we heard a lot about soft landings. You mentioned that just briefly. Do you think this enhances the concept of what is a soft landing?
Yeah, I think if you're working at the FOMC, you're feeling more confident about this soft landing narrative. What is a soft landing? The soft landing was this idea that we could slow, and I think it's an ambiguous term, so everyone can have their own definition. But as I think about it, it's the idea that we could slow the economy, get inflation back under control without tipping the economy into a recession. We wouldn't have a economic sort of disaster on our hands. And so there's a lot of finessing that had to go through that, and a lot of luck. And I'm not sure we're on the ground yet, but I think we're definitely making progress in the right direction. So inflation is cooling, and we haven't seen a huge blow up of the economy at this point. But keep an eye on it. Again, it's an ambiguous definition. It's going to mean something different to everybody, but I think the Fed's feeling more confident about their actions and that patient but deliberate movements that we talked about. I think the Fed's very confident that their patience and their deliberate, decisive moves have paid off both when raising rates and now when lowering rates.
The next question I want to ask you is kind of like about the United States on a world stage. So there are other countries that are having their Fed meetings after ours. How do our decisions influence maybe the global economy, and what predictions do you see on that front as to why we lead that charge?
Well, that's a great question, and I think I didn't even do a good job of setting up the global stage here in this conversation. But the first thing I want to point out is inflation has been troublesome for every country. This is not just a U.S. phenomenon. We did see other central banks lower rates throughout the summer when the U.S. Federal Reserve was slow to do that, and so there was a little bit of criticism or critique about why the Fed was slow to adjust. And now we saw, I think, the Bank of England last night decided to not lower rates again, but they had already made an adjustment back in August. And so the idea here is that there is a global challenge around inflation. There had been a global sort of trend towards raising rates and now maybe pausing or lowering rates just a little bit. And of course, why does the U.S. economy matter so much, or why does the U.S. decisions matter so much? Because it impacts a lot of global trade. We touch a lot of different facets of the global trade. In fact, the priciness of the dollar, so to speak. And so when we're trading currencies, that's another key consideration that investors are looking at when they're making those decisions.
Next, I know you've already kind of talked about, but maybe just a little bit of an expansion, how the FOMC decision influences yield curve on bond rates.
Well, that's a great question. I think the first one to think about here is the FOMC decision is going to more directly impact those short-dated maturities. And so, that FOMC Fed funds rate, that's the rate that they're changing, and then the rest of the debt market sort of uh, adjusts accordingly. And so we're going to see the short-term rates trend lower, and there will be some impact on long-term rates. But I think the big question, and we got to sort of step back and watch this play out, is I don't expect the yield curve inversion to last for forever. It's been around for quite a while, but the question is, how does that uh, inversion work its way out of the system? Do short-term rates come down a lot? Do long-term rates go up? Is it a combination? And I think at this point, my expectation would be um, you might expect short-term rates like a line of credit to see more of an adjustment downward than long-term rates, such as a farmland loan or a home loan. But it's a little too early. We'll see how this works its way forward. I think the other thing to keep in mind is that the Fed is also selling off its balance sheets. We've talked about that. That's another form of braking for the economy. They're doing it at a slower rate, but that also impacts maybe some of those longer dated treasuries, close to those 10 years. So the Fed has sort of some controls and some influence over both sides of that yield curve. At this point, they're definitely focusing on getting those short-term rates lowered.
So that leads me into my next two questions, and you set it up perfectly. One of the participants asked us if we will ever leave the inverted yield curve environment. And based on what you just said, you have a belief we will. But do you want to expand on that any?
Yeah, I think, if you step back and you think about that relationship between the cost of borrowing money for, let's say, 1 year versus the cost of borrowing money for 10 years, there are some reasons why you would anticipate, a premium for longer dated loans. And a lot of that's just the uncertainty that happens over those, 10 years. Um, so if you're loaning money, you'd want to charge a little bit higher rate to capture some of that. So we're in this inverted yield curve environment, and I think what causes this inverted yield curve environment is sort of a disconnect between short run expectations and long run expectations. And so when there's a lot of uncertainty about the short run, but we're still confident about the long run, that's when you start to see this inversion. And I think the economy is starting to, reach more of an equilibrium. It's starting to behave in a more quote unquote normal fashion. We're getting inflation under control. The labor market is reaching full employment, isn't overly tight, and that's providing some confidence about the short term. Now, how long will it take for us to get to a more normal yield curve? I don't know. It could take a while. Probably once we remove the inflation uncertainty. That if we could remove that overnight, I think the yield curve would start to be in a more normal relationship between short term and long terms. I still think inflation is still elevated. It's going to be elevated for a little bit, and I think there'll be some fits and starts. But I think as inflation works its way out of the headlines, that yield curve will start to clean up.
So let's talk about the 10-year Treasury. You had mentioned it two questions ago. What, if any, immediate impact will we feel in that 10-year Treasury? Do you have a timeline on your mind?
I think we should watch it over the next 30 days or so to really see how this is going to play out. Of course, there are overnight movements. I think sometimes that's, overplayed, but what we want to see is how this plays out over the next 30 days or so. I think that's going to start to give the Fed some, I guess one thing to think about is the 10-year treasuries is not, the Fed funds rate is sort of the Fed actually pricing things in a very tight band. This is a sort of a set price. The 10-year treasuries, for another example, is traded on a market. And so there's a marketplace out there. And so that's going to give us an idea of how the market is reacting to the latest Fed fund data, but also moving through the supply and demand for those longer dated maturities. So watch it over the next coming weeks. We'll see how this plays out. And I think that's going to be one of the data points that the Fed watches to understand how the economy is reacting and absorbing the lower interest rate environment.
David, if you're a farmer sitting in Indiana right now, how do you use this information to maybe guide your thinking on the farm?
Well, I think the first thing to keep in mind is that short-term rates as we speak this morning, or maybe even yesterday, short-term rates were still at a higher threshold than long-term rates. And so, as you're thinking about your borrowing needs for 2025 and beyond, you might need to think about, what kind of debt might I be needing to take on. So we might be hesitant to use debt given its price, but maybe on a relative scale, we should say maybe I should look at using debt to maybe buy this piece of equipment or buy these pieces of livestock rather than relying on an operating line for next year. That's one example. Another example I think is really encouraging is that we might see some lower interest rates for operating lines, especially coming into 2025, but also thinking about where these interest rates might be going for 2025. We saw the opportunity for a couple more adjustments here in 2024, and then maybe another 4 cuts in 2025. The last piece I want to point out here, this is the challenge for producers, is there's a lot of uncertainty around interest rates. I talked earlier about from 2010 to 2020, 2021 or 22, we had a low interest rate environment. And we also had a very stable interest rate environment. So you think about how much volatility, how much uncertainty we had between 2022 and 24, and now we're seeing some maybe downside, but it's a pretty big range. So I think producers are going to need to not let sort of analysis paralysis set in, thinking about, oh, should I, pull the trigger on this decision today, or should I wait for the next Fed meeting, or should I wait for the next piece of information to come in? Because there's going to be this temptation to maybe wait because interest rates might be lower in 6 months or 9 months. I just don't know how much confidence we can really truly have in those Fed's projections. They're the best projections that are out there. These are the people who, at the end of the day, are setting some of these interest rate decisions. They're the ones who are voting on interest rates. But there is still a lot of uncertainty in the U.S. economy, the global economy, and in turn the interest rate markets. And so just be careful not to sit around waiting for interest rates to get lower, because as we saw earlier this year, the Fed had some pretty aggressive plans at the end of last year and the beginning of 2023, and they cooled off on those plans, and now they're back on sort of on this aggressive interest rate cut plan. I just think we've got to recognize the uncertainty that's out there and the wide range of possibilities that could be looming.
Well, thank you so much for your time. We appreciate everybody joining. This was recorded, and we will follow up with the recording and send it out to all registered guests. And so with that, thank you all so much. Thank you, David, for your time. We appreciate it, and we'll see you all next time.